Jesse Cohn is one of Wall Street's most influential investors. As managing partner at Elliott Investment Management, he's helped shape the strategies of major companies, Twitter to Salesforce to AT&T. Known for pushing boards to unlock value and sharpen execution, Cohn represents a new era of active ownership, where investors don't just take positions, they drive transformation.
We have a couple more. Thank you so much for sticking this out with us, and Jesse for joining us and coming up from Florida to do this.
Yeah, thank you.
So Jesse, Elliott's reputation, and it does a variety of different things, but it kind of, no matter what it does, whether it's in the public markets or the private markets, you guys are an active investor, not just an activist, but an active investor. But public equities are becoming more and more passive right now. Are you a dinosaur?
Well, I hope not. But your point is the right point. 60% of the funds, the money in U.S. equity funds, is now in index funds, and this is kind of a really big deal. And I'm glad you started with it because it's kind of where our focus is. The U.S. markets were built. The whole premise of our markets were built on the backs of active investors, people actually choosing which companies deserve capital. Active investors doing work and saying to a management team, we like your innovation, here's more money. We like the direction you're taking this company, here's a higher valuation. And on the other side, saying to a management team, you're shrinking, here's less capital, here's less money for your business. And that sorting mechanism, that meritocracy, is what built our markets. It's what built our strength of the US economy. Everything we talk about, NVIDIA's printing suit, these are public companies. And so you need active investors, but we now have 60% of the funds in passive money, and that's a big deal for
Practically
us.
speaking, what do you think is the market implications of that?
Well, there's less dynamism. There's less choosing. Passive investors are there to participate in the market. They're there to ride the index. Active investors are there to choose which companies are prospering and give them more money and so on. And you're going to have a less dynamic market. You're going to have a less accountable market. It kind of brings you back to pre-World War II, when management teams were insulated and the board was a rubber stamp, and they didn't care about how they allocated capital. And the active investor base changed that. And now we're kind of at risk of going right back to a passive base that owns everything, doesn't choose, doesn't select.
Is there something, and I don't know if it becomes a specific situation, is there something that you think would flip that and push it back in the opposite direction, back towards where you want it to be?
Well, the US government is looking at this now, which we welcome. And I think everybody realizes it's a big issue. And people are talking about the fact that there needs to be a change, because we are at risk of ending up with a less dynamic, a less healthy market, a less healthy economy. And so there's an executive order that's been put forth saying we should study this. This is important.
On the executive order side, there's also this push against proxy firms right now, which I guess is partially what we're talking about here. They're not proxy firms. I assume that would be something you're against. Am I wrong about that? The kind of the tamping down on their power?
Well, what we're for is actual active investors making choices for the company. And proxy firms are there to render a verdict and help people understand that. But
they're also there to, in part, not be a rubber stamp for management, which is
correct, which is important. And I think when we look at this and we say, well, how do we create a healthy market? We create a healthy market with the meritocracy and people voting. I think it's worth raising that the big three right now, BlackRock, State Street, and Vanguard, own like 30% of the register in these companies, and they're not voting and they're not choosing. And the founder of Vanguard, Jack Bogle, right before he died, published an op-ed warning against the fact that these three index holders would control U.S. companies, and that would be a major issue, and that was not in our national interest.
So if you were in the White House and you were able to issue an executive order, not one to study something, but to actually do something, what would be the thing you'd want to do?
Well, I would have to take a look at this and come up with the right answer. There's been a lot of proposals floated. When we have a view, we'll render our view on where we're at. But the reality is that this is an issue that absolutely needs to be addressed. We can't have.
I guess that's what I'm asking. Is it something that can be actually addressed by regulators, or is this just the way of the world? Obviously, people have a choice, right? I can either be a passive investor or an activist investor. The government can't force me to be one or the other, or I can be not an investor at all. What, from a regulation standpoint, could actually be done that would change this, as opposed to just people suddenly decide, you know what, this is good or bad business?
We have to look at the voting. We can't have a situation where passive investors who are not choosing companies, who are not holding management accountable, who are not leading to market dynamism, control the votes at our largest US companies. We just cannot have that. It's not healthy for us. It's not good for our economy. It's not good for our savers. It's not good for anybody with money in the market. We got a lot of VCs here. You have a situation, every VC company likely will end up somehow affected by public companies. Our Mag 7, these are all public companies. We need a healthy market, and that's at risk if we have no voting and no accountability.
Obviously, Elliot sometimes buys private companies or brings companies private. Do you feel then, are the private markets right now healthier than the public markets?
Well, the private markets have their own, sort of
They do,
issues.
that's why I'm asking. But they have active management almost.
They do have active management. And the private markets do not have a situation where management and ownership are completely disconnected, which is the risk here. We have a management that feels like it can do whatever it wants because it knows that the shareholder base is not actually voting. That brings us to like Japan pre-reform, where you had interlocking companies and bank-controlled companies, and their economy didn't work out very well there. We want the US to be healthy. We need this issue addressed, and I'm glad that people are looking at it.
You brought up Japan, so I'm thinking a little bit about the US Steel situation, not that you guys were involved in that, but one of the things that ended up with was, this is kind of another politics question, was the US government becoming a shareholder, in that case in US Steel or in Nippon Steel. It's obviously invested in Intel, it's taken stakes in a variety of different mining companies. Is it a good, you're a public equities investor, is it a good idea that the US government is also becoming a public equities investor?
Well, I'm not going to touch that, but I will say that it's a good idea that we are engaging with companies and trying to make them better as an active holder.
If you were in a company, if you had X% of whatever company, and it was, and the White House or the Commerce Department suddenly takes a 2, 5, whatever % stake, are you happy about that, or are you not?
Again, I'm happy to have an active role in helping companies do better, and in helping them to be accountable to their shareholders, which is at the heart of what's made companies better. Meritocracy. We need that. We need votes. We need voices. We need choosing.
Why are so many CEOs, generally speaking, and boards, dislike activist investors as a class? They dislike Elliott specifically in a lot of cases. You are one of the ones they are most scared to find has shares in their company. Why?
I haven't heard this. No, no. I think at the heart of it is you want shareholders, including us. Activists are just the most active, but any active holder is pushing a company to perform. People don't like to be pushed to perform, but the reality is that's what makes our market. That's what makes companies accountable. When they are doing something that is not value maximizing, and someone is saying to them as a check and balance, hey, that's not working, and they have to change course, they may not like it, but the reality is it makes them better and stronger. And that's just true generally of all active holders.
Are there certain red flags for a public company that particularly get Elliott's interest? And I don't mean are the things you ultimately invest in, but the thing that puts a company on your radar in the first place?
It generally comes down to capital allocation. Are you making the right decisions with your money? Are you buying the right things? Are you spending it properly on R&D? Are you hiring the right people? Is your expense?
But when you say that, thousands of companies are making acquisitions, are making hires every single day. You can't track every hire at every company. I mean, C-suite ones, I guess you could. What within that is the thing that puts an alarm bell on some analyst's computer to say, this is one we need to dig deeper into?
If it's poor. I mean, the reality is that every situation is super specific, but are they doing the right things with their money? If there's a growth opportunity, are they spending for that growth? If there's not, and they're spending somewhere where there's not a return, that's the wrong decision.
How do you kind of indicate that a company is undervalued versus fundamentally flawed?
Well, it's not pure valuation metrics. I mean, that's
no, but there's certain companies that changing the management, maybe divesting something, that's not going to fix it. There's a fundamental. This is not a savable company. This is a dinosaur again. This is a company that's going away, kind of no matter what we do because of what they do.
It has to be a durable business with a right to exist. That's what we say. And if they have a right to exist, if they have a market and a right to win, they have a place where they can allocate their capital appropriately. If they don't, it's probably not something we're going to invest in. And there are slow growth and fast growth companies that are appropriately allocating capital. We invest across industries, we invest globally, we invest across different growth profiles, but they all have different needs and they all have different ways to spend their money in the proper way.
What helps you determine whether you should, and maybe the answer to this is size of company, that you should become a small shareholder and agitate for change as opposed to help try to, or either alone or with someone else, take the company over and actually own it?
Yeah, we're large, and so we will make the determination on what will be most effective, what will give the highest return for our clients. Some companies we can buy and own and run ourselves. Other companies.
But is that about internal capabilities to run that sort of company? Because obviously, if you're in charge, you can then make the changes. You don't have to be asking to make the changes.
Mm-hmm. That's part of it.
When you decide you're going to do an activist campaign, is there a threshold that you guys decide from an ownership percentage that you actually have a voice? Or if Elliot buys 10 shares, do you have a voice because you're Elliot and you own a couple shares?
We could. I mean, we don't typically have 10 shares. We'll usually be one of the largest holders or one of the largest active holders. But our goal is that when we show up, people know we've done our homework and that other holders would probably see things similarly and that we can achieve what we want to achieve. And so we've been a small portion of the company's register, but still effective because our arguments are right, generally. We make mistakes.
You've been with the firm for 2 decades. Do you think this is you personally, Jesse, do you feel you operate differently now? Not just than when you started, but do you feel there's been any significant change in the way you interact with management at companies?
I think that as we've grown, and scale is one of our biggest advantages, we've been able to bring more resources to situations. I mean, we'll show up at a company with an operating team, with a governance team, and with deep knowledge of their base, deep knowledge of their markets. And I think companies have more generally come to appreciate that we add value to them, we add value to their shares, and we've been invited on boards, we've dealt with the world's largest companies, we've dealt with dual-class companies, and I think there's now more of an understanding, hey, this could be good for us. This could help us create value. This doesn't have to be adversarial. And that's actually brought the temperature down generally.
But you say that it's coming from the company side. Is it also coming from your side? Do you feel you're less adversarial going into situations?
We are. We are because we're still firm. I mean, how we respond to a company depends upon how they respond to us. We show up the same way every time. And if we are welcomed in, which increasingly happens for our ideas and our resources, then it's great. It's a conversation and it leads to something. Some companies don't want the help, and if we think that the help is needed or required or merited, then we'll push our case. But more often than not, it's the former category.
You mentioned scale. You guys are large now, I think over $75 billion in AUM. There's some who look, and this kind of got talked about a little bit in your third quarter letter as defense against, that your scale has become a bit of a drag on performance. You talked about scale as a positive just now. Has scale become a drag on your performance?
Well, I can't talk about performance, but I will say that scale is one of our greatest assets and resources. We can come in.
You can talk about former performance, just not forward performance.
I'm not talking about any performance. Scale is one of our greatest resources. I mean, we've been around a long time, almost 50 years. We're constantly looking at everything we do. But we repeatedly come back to the place that we can bring more resources to any situation than any of our competitors, than anyone else out there. When we look at a large company, we have an industry team, we have an activist team, we have a comms team, operators, we have former CEOs and CFOs. And
is that the main thing that you think has changed with size, or has the playbook at all changed with size?
We have more tools. We have more tools. I mean, 15 years ago, there wasn't an activist market This wasn't a thing. There weren't reporters covering it. Now there's a tremendous amount of infrastructure around it, and we can show up at extremely complicated companies with, we have consultants that work for us from all the former consulting firms, and we have plans for them. So we have more tools in our kit, and companies receive that value well. And we operate as almost a shareholder consultant. We join boards ourselves. We help them achieve better value.
You talk about the kind of this large staff and this large roster. When you think of Elliott in 5 years, 10 years, do you think there'll be fewer of them because AI is going to replace a bunch of those functions? Same output, but fewer humans?
Well, probably not, but we are certainly finding ways to use AI productively, and it's helping us with research, it's helping us with reports, but at the heart of what we do is human judgment. It's what we call manual effort. We look at these companies, we try to find, help them with their strategy, help them with their operations. We make decisions, we have relationships. That's a very human element.
Well, I mean, it's interesting though. Like I think, for example, of General Atlantic, the private equity firm, they have an AI now that sits on their investment committee. It doesn't get a vote, but it's there, and it sometimes disagrees with the other people around the room, and it gets a fair hearing. Could you see something like that in Elliott?
I mean, we use AI, and we certainly use it for research, and possibly.
But do you, okay, so you use it for research. When I say do you ever ask it, depending on whatever systems you're using, do you ask it to help, not help with decisions, but what do you, like, should we do this? Should we not do this? And then, and if it disagrees with you, give that kind of a fair hearing? Are you there yet?
We take the inputs. I think at the end of the day, and at least as far as I could project, it's going to be human-led judgment about these situations. It's operational, it's what will resonate with the market, it's what is strategy. For now, I think that level of complexity is best served by our investment team.
Last AI question. You started really focused on tech. You as a teenager, et cetera, you started Elliott and kind of built this tech practice. When you look at kind of what I talked to Roloff a little bit about earlier, these kind of pre-GPT companies, generally, companies you're investing in are older than that. How do you feel you can accurately identify companies that are able to make the pivot compared to ones that are absolutely being disintermediated, and while their idea made sense 10 years ago, they don't make sense as a company 10 years from now?
There's a lot of uncertainty, and I think that creates a lot of opportunity for us. We have a huge team covering the space now. We own a large private portfolio that's deploying AI, and a lot of the suppliers to them are some of these companies. And so we view the dispersion in the market, the winners, the AI winners, and the losers, as being a tremendous opportunity set for us. We're going through these companies, we're trying to make evaluations about which will benefit, which will lose, which can improve their operations in the face of this. So there's a lot of uncertainty. Uncertainty is good from our standpoint, and we're finding a lot to do.
Quick lightning round, 3 questions, because I've got 18 seconds. These are 3 companies that you guys have been involved with. You last flew on a Southwest flight when? Ever?
I did. I went to Scottsdale with my brother.
All right, fair enough. You stopped tweeting in 2023. Why?
I don't know. I should reemerge as a Twitter user.
Reemerge as Twitter. And final question: your favorite Pepsi beverage?
Pepsi Zero.
Jesse, thank you very much.